Earle. We're live on Twitter Spaces, YouTube, and I'm getting a lot of feedback from the last time we've had Peter Earle. We'll have Peter give his origin story of how he became interested in finance and the economy. But a lot of people want to know, will the dollar survive? I'm getting a lot of calls. Do I put my money in Bitcoin? Do I put my money in gold? What the heck do I do? So before we begin with that, and kind of the listener questions I've been getting since your last time on the show, describe your background in finance for those who are not familiar with your work.
Sure. So I got out of the military in 1996, and like many kids who grew up across from New York City and watched the movie Wall Street in the late 80s, I wanted to go to Wall Street. But of course, I didn't know anything about it. So I worked as a stockbroker for 2 or 3 days. I did a few other things. And then I found that what my real calling was, what I was interested in, was trading. So I began trading in a few firms, and I spent almost 20 years, or 20, 21 years it was, doing that with a few side distractions. I got involved in crypto at one point. I started a consultancy at one point, and it was being invited to AIER, to the Sound Money Week, and attending the events of that, and then them offering me a job, which led me to now pursue sort of taking my trading experience of 2 decades and applying it to financial markets and all that. So I'm an economist here at AIER, and I cover financial markets, monetary policy, and a few other issues, crypto, commodities, all that sort of thing. Everything you might expect from somebody who spent 20 years on trading desks at large and small firms and hedge funds.
So let's first talk about the problem of de-dollarization. Then we'll talk about, what do people do with their money? So first, describe the phenomenon de-dollarization, as you term it.
So there's been, it's nothing new that a lot of firms are kind of trying to get away from their dependence on the U.S. dollar. As early as or as late as whichever way you look at it, 20, 30 years ago, there are attempts to create different types of currencies for international trading. Right now, the dollar is the means of trading internationally. If you want to do a multi-billion-dollar oil trade, if you want to do something else, whether it's, Russia with, Finland, or North Korea with Australia, whatever, it's almost always done in dollars. Dollars are liquid, dollars are well known. The Federal Reserve makes a lot of mistakes, but it's still sort of the gold standard in central banking. So the dollar is really, since not only the Bretton Woods Agreement, but even after the Bretton Woods Agreement ended in 1971, the dollar has been the lingua franca. It is the way that we trade internationally. Trades are denominated in dollars, they take place in dollars, and they settle in dollars. Now, 2 things have led to a shift to get away from that. The first is the sort of error-prone Fed policy of the last few years, where we had the Fed create tremendous expansionary policies to address the COVID pandemic. And then when inflation broke out, they called it transitory and ignored it. And then they had to play catch up. So they raised rates 5.25% over a course of 14 months, which destabilized elements of the financial system. It's now causing problems for individuals who have credit card debt. We can talk about that later. But that's the first issue. And the second issue that's making countries running away from the dollar is seeing the effects on Russia of the U.S. kicking a number of Russian banks off of SWIFT in the wake of the Ukraine invasion. Many nations didn't know, I don't think, until recently, exactly how dependent they were on the dollar to access international markets. And so a number of nations now are more actively, especially in the last year or so, trying to come up with alternatives to the dollar. And it's not a phrase I made up, but I wrote an article called "De-Dollarization Has Begun," and I cover a number of issues that have happened lately and projects that are taking place to try to disintermediate the dollar from the international trade prospects of any number of countries around the world.
So that was a mouthful. So you didn't. So what do we do? Do people put all their money in gold, Bitcoin? If I'm looking, we have a technical analyst on the phone at the firm. He thinks gold's overbought right now and is due for a little correction. But I get a lot of listeners saying, should I put all my money in gold? What do I do?
So the first thing I should mention, and I wrote the article first, and I got so many questions that I then wrote a follow-up. The first thing is that this is not something that, even if it were to take place in a very streamlined manner, it would take decades. This is not something for Americans to be worried about. I'd be much more worried if I were an American, and I am an American, more worried about the stickiness of inflation, the fact that we seem to be entering what looks to me like a stagflationary environment rather than the run-of-the-mill recession. Those sorts of things are much more important and much more pressing issues right now. De-dollarization, which let's just call it the removal or the joining of the dollar with other currencies as the global reserve currency doesn't necessarily mean the end of the dollar. It certainly doesn't mean the end of the United States. So there would be some long-term effects, but it's not pressing at all. This would take many, many years to happen because there's a whole financial and economic and infrastructure, around the dollar as a means of trading internationally. I mean, people think in dollars around the world. So this is something that I chose to write about because I'm an economist and I see things picking up pace. But even at this pace, we're talking decades, 20, 30 years, maybe more.
I mean, let's talk about 20 years ago. Right now, the dollar reserves, I don't know if this is an accurate stat, but the dollar accounts for roughly 60% of global currency reserves. Is that an accurate number, first off?
I think it is, yeah. I think it's about 60% dollars, maybe 30-something% euro, and then you have the English pound at about 6%, and then you get down to less than 2% for many of the others. That's about right, I think.
And then we'll also talk about your opinion on China. Will China kind of fill the vacuum?
Right.
But it was 70% at the first part of this century. I've seen some stats that said 80%. Sure. And that's what's troubling to me. So, maybe your article caused some alarm and people kind of picked it up, maybe went viral even. If we're going from 80% in 2000 to 60% in 2020, we're looking at 40% in 2040 at just kind of that not frightening rate. So I view the dollar's on the way for the British pound. Sure, the British pound's 6% of global U.S. trade, or the euro, but every year we don't get our debt under control. We don't have sound fiscal monetary policy. Other countries are going to say we're not a good partner. And then you have misinformation like a big thing with Trump and the euro. Remember that thing, the Pacific thing that nobody liked? What was it? It was like NAFTA but for the Pacific area.
Yeah.
Once we got out of that, that was very bad for the dollar because although, you might have not liked Hillary Clinton or what Barack Obama was doing, at least it was kind of making the U.S. the major trade partner for much of the Pacific Rim. Like that was a good thing. And then people...
Yeah.
Kind of this surge of isolationism. Now, China filled that vacuum. So what do you think about that?
So the loss in, if you want to call it, I mean, it's not really this, but let's just call it the loss in market share for the dollar between 2000 and 2022 or whatever, 2023, has a lot to do with the introduction of the euro. So that's a big part of it. What happens now, between now, 2022, 2023, and say, 2030, 2040, that will more likely be a product of nations trying to hedge away from Fed policies and from the use of the dollar as a sanctioning tool. But in terms of what the dollar, what being the reserve currency gives us, and what we would lose if that would change, one of the reasons why the U.S. has been able to, it's a mixed blessing. One of the reasons why the U.S. has been able to build up $31 trillion debt position is because with the dollar so widely used and sitting in piles of central bank coffers and currency board coffers and also large corporations coffers around the world, their FX reserves being mostly in dollars, they want a means to generate interest, which means they want treasury issues. They want treasury securities, whether they're bills, notes, or bonds, agency securities. So that has given us sort of a really almost an insatiable appetite for U.S. Treasury issues. Now, if there was less demand for the dollar, we would see, especially now at $31 trillion worth of debt, we would see less of a market for U.S. securities, U.S. government debt. And that would mean that the yields on debt would go up. You'd have to pay higher interest to be more competitive. And also, some people don't want to be the last people to buy debt. Some firms, some countries don't want to be the last to buy debt on a country that's almost certain to either default or just not honor its obligations in another way. So I think that's the real risk is not even in the dollar not being used as globally, but it has a lot more to do with what the dollar being at the center, being really the center of gravity of the global financial system has meant to our ability to issue debt. And some would say, maybe if the dollar has to become second to the euro, second and third to the euro and something else, that might be worth it for us, for our sound money and for our financial, our economic health as a nation.
And we're also going to talk about your latest article, The Path to Full Stagflation. Folks, we're with Peter Earle, prolific author. What is your latest book, Peter?
The latest one was The Gold Standard, Retrospect and Prospect, but I've had a few chapters in other books since then. That one came out in 2021. I wrote it with an economist by the name of Will Luther. I think you've met him.
Yeah.
And we wrote that book to sort of commemorate, not necessarily in a celebratory sense, but to sort of mark the 50th anniversary of the end of the Bretton Woods Standard in 1971. And what's interesting is that you would think that the end of the Bretton Woods Standard, where the dollar was sort of enshrined and put into the role of the global currency, global reserve currency, would be in the end. But this process is so path dependent, and the barriers to entry are so high, and the costs of exit are so high, that the dollar has nevertheless remained the global reserve currency, even in the 50 years since that agreement formally ended.
Fantastic. We're with Peter Earle, author of The Gold Standard, Retrospect and Prospect. We're taking questions for the audience on YouTube live right now. Also, Clubhouse, iHeartRadio, WOR, New York's one of the biggest AM talk radio stations in the country. And we'll take your questions now at 888-988-JOSH. If you want the free 45-minute What Do I Do With My Money review, we'll give you the book, The Gold Standard by Peter Earle, for free when you schedule and keep your no-obligation appointment at 888-988-JOSH. If you have a question, type it in the chat box. We will go to you. We're going to be talking about the gold standard. Let's talk about the gold standard, and stagflation. When we return, this is Josh Jelinski and a Bitcoin standard. A lot of people know, hey, are we going to Bitcoin? When we return, this is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're with Peter Earle, author of the new article on the AIER.org, the American Institute for Economic Research, the full path to stagflation, and also get your take on what's going to go on with the economy, the stock market. It's not necessarily your thing, but we will see. So give us a call, 888-988-JOSH, if you want that book, The Gold Standard. But first, so we talked about de-dollarization. Get a lot of people right now say, should I put my money in gold? Like, I'm getting that more and more. Personally, I don't think gold has, some days I'm for having, a certain percentage of one's portfolio in gold. Let's say 2 to 5% is just a asset allocation play. But other than that, and maybe, if somebody wants to have some gold in their house, just to make themselves feel better, if we go to a CBDC, like what is gold going to actually do if we have a CBDC standard? You know what I mean? Other than it might go up because people think it's a hedge.
Yeah, the thing is that gold has been for many, many years, it's been sort of the original, the famous original safe haven asset. People put their money in gold. Now, you could buy gold at $1,000, just to use a round number, $1,000 an ounce, and it could fall to, say, $900 an ounce. Now, you're going to get $900 back, so you didn't actually, it's not a perfect hedge, but you're more likely to get some of your money back, whereas in other issues like, say, some securities or maybe government bonds or whatever, in an extreme situation, you might get nothing back. So gold is a hedge. It's a hard asset. It's a light sort of metal you can carry around. Of course, to carry it in any volume, it's heavy. It's impossible to counterfeit. It takes work to get out of the ground, so the amount of supply changes very infrequently. The demand goes up when there's unrest and when there's financial crises. So, I mean, it really depends upon the person. Some people think that, obviously there's some people out there who think that you should have a portion of gold, not only in terms of like GLD or something like that, but also in physical gold. And other people say, the time to buy gold is always long before a crisis starts, so you're always going to be late and pay the higher prices. It's hard to say. I know the historical significance of gold, and to a lesser extent silver, and I've heard people say, yeah, you should have a little bit of it, whatever. It's really up to the individual's sort of risk appetite and also their perspective about where they are in their career and where they are towards retirement and how bad they think things are or will get.
Yeah, I think also technically, if you look, we have a market technician on staff, and he talks about a 94-month cycle in gold. And I don't know how, he sent me proof that if you go to March 1976, you fast forward 102 months, you got 1985, low in gold. Fast forward 97 months, March 1993, 97 months, April 2001. 90 months from 01 to 08, 08 to 2015, and he says the next one's due May 2024. So he's not, technically he actually says gold's bad. I don't know, what'll happen. Sure. I like it, I guess, as an overall hedge, but to me, the big risk right now with our currency is the, central bank issuing some CBDC that will be a means of control. And so I don't see how you go to the grocery store and let's say the government bans gold or bans coinage for the use of, like they did in the 30s, because they're trying to get people to not have a black market or something. And, someone's doing nefarious activity or money laundering. So we're going to have the CBDC. The grocery stores that complied with the COVID mask mandates will most certainly comply with the CBDC mandate. So, it's a store of value. It's, an ounce of gold bought a fine Roman tunic 2,000 years ago, kind of buys a fine suit.
Men's suit.
Fine men's suit today, that whole store. There's truth to that. It's just, I think a lot of people, if you want to have 5% of your portfolio or 50 grand, lying around in gold as a hedge, I'm totally fine with that. But I would be very leery of gold people on the radio or on conservative news stations selling you gold, largely with the 7 to 10% commission on the buy and the sell. And, only do so, I would say, based upon your overall asset allocation and financial plan. But I get it. It's scary. CBDC is kind of a scary. Florida's banning a CBDC. Yeah, let's get your opinion on CBDCs.
Yeah, so just as you mentioned, I've received a lot of calls or a lot of messages and that sort of thing about the de-dollarization article. And as I was saying before, the implementation of a central bank digital currency, especially if it's meant for consumers and retail people instead of wholesale, is something to be much more worried about than de-dollarization at this point. The concept of a CBDC, if it's used in a retail capacity, which is to say, if there's an effort to go to a cashless U.S. economy and have everybody have some sort of a wallet, a digital wallet with notes with digital currency, the way a Bitcoin wallet would work, is much more of a threat, and it contemplates a financial surveillance state. What it means is that everything you do will be watched. They will over time, under the auspices of getting better financial data and, being able to provide a better beige book to the Fed or to the Bureau of Labor Statistics or any of these other government bodies, under the auspices of getting better data so they can create better policies. What it will do is it will make every transaction you do, the length of time your money stays in your account, what you spend on, how much you tip, everything you do and where you do it will become a matter of digital record to be used. And that will in turn, I think, just like so many other things, will eventually wind up being used for no good. And by no good, I mean eventually, in the same way that if you are somebody who, I don't know, what's a good example? If you get behind on child support, or if you owe money to a government agency, you can get your driver's license taken away. You can have a lien put on your bank account. I think the range of things that will be penalized by directly punitive financial measures will expand broadly if that kind of information is available. Additionally, the reason why a CBDC is so interesting to the government is even beyond gathering more data, is because if there's no cash in the economy, it's a way to implement unconventional monetary policy. Right now, the Fed can't really set negative rates, because with negative rates, you would have people pulling their money out of bank because you would be paying to keep your money in a bank instead of receiving interest. And negative rates is a way that the Fed could kind of expand their policy range. Right now, there's a very hard limit at 0%. But the reason they can't do that in a cash economy is because if people found out they would be paying to keep their money in a bank, they would pull their money out, and that would be bad for banks. So there's a lot of sinister implications to the implementation of a cashless economy and a CBDC, and it's something that I think more people should be concerned about, but they aren't.
So what do you think about Florida Governor Ron DeSantis and other states, Indiana, Louisiana, Alabama, Texas, North Dakota, North Carolina? House voted unanimously May 4th, 2023. I would say, hey, get everybody. Maybe I can run a state campaign in New Jersey to ban CBDCs. People don't like them. I mean, I don't think anybody on the left or the right wants the surveillance state to grow. But here's so what do you think about these state policies?
I think it's a worthwhile effort, and I applaud them for it. But I mean, the thing is that so many times states have tried to separate themselves from certain government policies, and eventually they're tied to the federal government for highway aid, for other sorts of programs. I mean, issuing money has much to do with the Fed and with Congress. So it's going to be hard to, unless some of these states issue their own money or something. It's hard to imagine how they can, over the long term, pull themselves out of that sort of an innovation. And in the same way that some years back, think about when every time they changed the $20 bill. If a state said we're not going to be part of that, how exactly would they do it? Would they form a repository of old $20 bills? Would they keep people from leaving the state? Would they keep people from coming in the state who come in the state from using them? It's difficult for me to see in a very practical way how that's possible. But to the extent that these states sort of pushing back against the CBDC concept, I think they're doing a lot of good by making people aware of it.
Fantastic. So what about, we have a comment on the chat. Indian government just declared 2000 RS note not tender. You want to comment on that?
So the Indian government?
Yes. Yeah, I'm not an expert in India, so.
Yeah. So if the comment was that there's a certain note, a note of issue from the Indian government that they deemed no longer legal tender, my guess is that they've either found that it's counterfeit or that they are trying to do something else. I don't really follow things in foreign countries, monetary issues of legal tender in foreign countries very closely. But there's a number of reasons why that could be. I would need a little more background or to do some reading on it.
So let's talk about Bitcoin. Do you think we'll go to some type of Bitcoin standard? I guess first talk about the rise of Bitcoin. Actually, first, just explain what Bitcoin is, because some listeners really don't know what it is. They just think it's like Beanie Babies and money. So there's some misconceptions about Bitcoin.
So on October 31st, 2008, a mysterious white paper appeared on a Reddit thread. It was written by a guy who is now known to be pseudonymous. The name used was Satoshi Nakamoto, and in it, there was a sort of a white paper. It was a white paper for a peer-to-peer decentralized electronic cash system called Bitcoin. The idea is that it was a trustless system where individuals would transact in Bitcoin. That Bitcoin would be, of course, it would gain value because it was highly secure because it's based on cryptography, and that individuals who were called miners would sort of oversee transactions. They would compete to package transactions in what's called a block, and the block would be added to something called a blockchain. The blockchain is public; anybody can look at it, but you can't really tell. It's not anonymous, but it's pseudonymous. Some new coins have actually made Bitcoin more anonymous, like Monero and Dash. But that was the creation of Bitcoin. And I can remember when Bitcoin was $1, $3, $5. It was sort of a hobbyist thing. It's been as high as, I think, 65,000 now. And what a lot of people like about it is that because it's quantitatively limited, there's an algorithm within the Bitcoin source code that says that there can never be more than roughly 21 million of them, which means it acts like a gold standard in that it's quantitatively limited. The other thing people like about it is that they can transact pretty much free of the prying eyes of the government and all that stuff. Although, again, it's not anonymous; it's pseudonymous, which means that if a government agency were to say, look at money leaving a bank account and then see a transaction in Bitcoin and then see, in short, the government can look for patterns and sort of tell who you are. But for the most part, it's anonymous, and people like it because it's sort of like a life preserver or something. Like, when nations have had financial troubles, Venezuela, not so much Zimbabwe, other nations, when there have been troubles and there's been inflation, people have been able to use Bitcoin to transact. It's been something of an inflation hedge, not really completely, but the problems are that it's very volatile. The price can change by a lot every day. My light keeps on going off. Forgive me. And and also that the government has really sort of painted it with a really negative brush. They've sort of created this idea that Bitcoin is a currency for drug dealers and for other people like that. But at any given day, I assure you, tens of thousands more crimes take place in dollars and euro than they do in Bitcoin. So that's just sort of slander against Bitcoin. Governments and central banks have a reason to fear it because it sort of disintermediates them, and there's no real way of tracking it. So of course, it's associated with things like tax evasion and with evading capital control. So nations like China that want to see everything that's coming out of the country, it's hard for them to track Bitcoin and other crypto payments. So that's the long and short of Bitcoin right now. But I mean, it's very volatile, and it's still very much in development. There's still a lot of issues being worked out of it at the present time. It's sort of an ongoing coding project, even as we speak.
Do you think we'll go to some type of Bitcoin standard in the future?
So because the algorithm in Bitcoin is one of its major selling points, and it's not amenable to monetary policy. So the way the Fed, during times of crisis, it enters into expansionary operations where it increases the money supply, or it increases the rate of increase in the money supply, or more recently, when we have inflation, it contracts the money supply. Those sorts of options are not available in Bitcoin. Bitcoin is not, unless the source code were to change, Bitcoin can't be sort of tinkered with to engineer those sorts of results. So CBDC is not an equivalent of Bitcoin. Any cryptocurrency that or instrument like that where somebody can change the way that coins are mined and sourced is not going to be a legitimate cryptocurrency. It's not going to be a legitimate Bitcoin or Bitcoin-like instrument. So if there were something that the government would come up with, it wouldn't have the advantages of that algorithm and that sort of finite supply, because they would necessarily want to design it in a way that they could affect monetary policy-like operations to affect its value, affect the demand for it, all that sort of thing. So I don't think they'll go that way. A CBDC will be compared to crypto or Bitcoin, but it's not by any means that, because they fully intend, every model I've seen of CBDCs fully intends for it to be treated just like the dollar, in that the Fed can change the supply and all that sort of thing.
We're with Peter Earle, author of The Gold Standard Retrospect and Prospect, which is our free book giveaway. If you call our office right now at 888-988-JOSH, 888-988-5674. Also, the author of the new article, May 3rd, called The Path to Full Stagflation, and an article on de-dollarization. We had him on a while ago that got kind of viral and got a lot of people worried, the world's going to hell. The the dollar is going to crash. Hide now. But I mean, I think, and I want to get your take on this for next segment, but I view money will soon be balkanized. You'll have some people who will transact in land, some in Bitcoin, some in gold, some in the euro, some in the dollar. And that's, I think, going to be the big kind of disservice to the U.S. and American citizens when they wake up and realize, people don't really value the dollar like they used to 20 years from now. I think it will be gradually. I don't think we're going to wake up one day and everything will be Bitcoin. But I could see, hey, if CBDCs get turned on, I could see that double the usage of Bitcoin and then cause the innovation like the Lightning Network and other things to really take off. And you sort of have this parallel, almost like Bitcoin sort of Venmo system that'll end up developing. And, I always thought when Bitcoin gets to where people can just use it like Venmo, and I know there's certain apps where you can, but I mean when the regular person can do it, that's when I think it will be a real risk and it'll be too late for the government to control it. And in actuality, because it's not anonymous and they'll be able to figure out through chain analysis and things like that who owns what, government will end up embracing it because they'll do what the SEC did with high-frequency trading, where if you have short-term gains, you get this little SEC tax. And I think what they'll end up doing, I think government will actually embrace Bitcoin because they'll say, hey, we'll be able to just tax every transaction. 90% of the people will comply with it. 10% won't. We'll get new revenue. I think they'll actually look at it as a positive. They might try to ban it for a period of time, but I think it's sort of the genie's out of the bottle with Bitcoin. It's too mature. What are there, like 70,000 miners or 68,000 miners?
There's hundreds of thousands of miners, and there's also thousands of different coins now. That's the thing. So your comment just now, I think, is right on. The question is whether Bitcoin evolves to be sort of a parallel financial system that sort of like, I hate to use the term because it refers to something else, but like a shadow banking or a shadow currency system that sort of follows the main economy, or whether it gets embraced. And I think some of the things we've seen recently, such as the IRS really sort of learning about Bitcoin and asking questions on tax returns, all that stuff. I think part of what we're seeing is a little bit of, if you can't beat them, join them type of thing. They realize it's very hard to suppress. Right now, the main way that the government tracks, or the governments around the world track cryptocurrency, is what they call on and off ramps. When your money goes from a bank into a crypto firm and then gets converted to some coins, or goes into a wallet, or when it comes out, when you cash out and it comes back to your bank account. That's the main thing. That's the main way that government tracks it. If there's a way around that, then it becomes very difficult to track. There was something else you said there. I think it slipped my mind, but I forget. Anyway,
Balkanization.
Yes. Okay. So first of all, right now, and this is a different point, but I'll get to the balkanization as well. Right now, around the world, in dormitories, in basements, in attics, in everywhere you can imagine, the next great leap is being produced. Somebody's coming up with something that's better than Bitcoin, or a tweak to Bitcoin. The cat is out of the bag. There's all these other cryptocurrencies out there. It's impossible to stop now. It's going to be a question of figuring out, for governments, it's going to be a question of figuring out how to live with them. Yeah, they could ban them. India did an outright ban. China did an outright ban. But what you find is that miners pick up and they move to another country. And the benefits to countries are, they pay taxes, they employ people. So not everybody is going to want to sort of stop the crypto train in terms of being a place where crypto mining takes place and innovation takes place. But the balkanization thing is interesting. There's been a sort of related to the de-dollarization topic, there's been an idea lately that we would be facing something called Bretton Woods 3. And in Bretton Woods 3, more countries, and eventually conceivably all countries, would issue currencies that would be backed by real hard assets. An African country might issue a currency that's backed by rare earth metals. A lot of countries, you can think of all the OPEC countries as having sort of oil-backed currencies, which would be titles to a certain amount of oil. Anything you think of, copper, rare earth metals, mercury, any elements, any precious resources or commodities could conceivably be backed. And the idea is that that would retain some sort of sovereign protection and also create a sort of a grounding for these currencies as they interact. Because the spectacle, I mean, whatever you think about Russia and Ukraine, the spectacle of seeing Russia kicked out of SWIFT and unable to access markets because they use the dollar for so much, really scared a lot of nations into thinking, wow, I could be, I could get into a dispute with the United States and I could suddenly, because of my dependence upon the dollar, be kicked out of international trade indefinitely. So there's a lot of thinking going on right now. That's part of the de-dollarization thing, but it's also part of this idea of Bretton Woods 3, which balkanization is a perfect word to use for it. Actually, Frederick Hayek in the mid-70s wrote something called, I believe, the denationalization of currencies. It's the same idea.
Yeah, I think you'll see that more and more. People will say we can't trust the government, and they'll run various parallel systems. I believe we saw that in the last few years with the run-up in real estate. People said, hey, we can't trust the government with COVID. I'm just going to buy a house. I'm going to buy some land. I'm going to buy some farmland in Yellowstone and pretend I'm, Kevin Costner. So,
or Grizzly Adams. Yeah.
I mean, I have a friend, a client who moved to Montana, a bunch of clients who moved to Montana. Regular house in Montana is like $1 million now. Used to be, 180,000 because people said, hey, I don't trust the government. I'm just gonna, it's like, people, it's like the same concept of gold, except with land, I guess you feel like, hey, I can farm it. I can grow stuff on it. I can buy a cow, So people are really worried about their money. They're worried about de-dollarization. When we return, we'll get your take on what do people do with their money? And we're not giving investment advice, but some tips of just how do people wade through this and stagflation? Are we here? How long will this last? When we return, this is Josh Jelinski, the financial quarterback, with Pete Earle, author of The Gold Standard, Retrospect and Prospect. Our free book giveaway if you call us at 888-988-JOSH, 888-988-5674. Operators are standing by, 888-988-JOSH. We'll be back after these messages. And we're back. We're live on YouTube, Clubhouse. If you have a question, type your question in the chat. We would love to go to you. I know, Singh, you had a question. Did you have a follow-up to that, Singh?
No, I just wanted to mention they've done this previously where the Indian government has removed the 500 and the 1,000 rupee notes from circulation a few years ago. And so just today, they announced that the 2,000 rupee note is removed, and that's the largest denomination. And so I just visited India for the first time in a couple of years, and I brought out currency. It's a cashless economy. Everything is run there on your UBI. Everything is taxed. Well, it's good and it's bad. The problem is it's centralized. Every aspect of it is tracked. And that's the beauty of Bitcoin when that comes in there. I've been in Bitcoin since the currency there devaluate from 400 to 40,000. That's from 80 about 30 years, but that's how much it's devalued. So most people in US, I feel there's no reason for them to flee to Bitcoin. It still holds value as much as countries are starting to use it less and less, but still it's the strongest. You go to any currency out, they're more than happy to take the dollar. That's one reason why I feel like the US will take the longest to adopt. You go to anyone, Venezuela, Iran, India, you have to tell them one time about Bitcoin. Explain it twice. They'll get it because they know by the end of the week, the cost of groceries, whatever they earned in their paycheck, it's 5%, 7% less. So, or more in groceries. So that's my point on that. I just wanted to share that with you and enjoy the conversation here so far.
Yeah. Any comments on that?
So now I understand what he's talking about. There was a book that came out a few years ago. I can't remember the economist who wrote it, but basically the proposal was made to eliminate, I believe, everything down to $100 bills or something like that. And the idea that was promoted in the book was that, $100 bills make it easy for drug dealers to do big deals, and a lot of crimes take place, and these big denominations make it easy to move large amounts of money around easily. It's a lot easier to move, $100 bills than it is, a million or 100,000 or whatever it is, dollar bills. So, that to me is a very specious argument, and these are sort of roundabout ways and emotional means of getting people to accept a cashless economy. And I don't buy it for a second. I think that it's important to have cash, and so that's what that gentleman was talking about, and I understand now. Yeah, no, that's it's a very slippery slope, and the arguments that are being bandied about in favor of a cashless economy are mostly, they are at the very least misleading and leave out a lot of facts, or they're blatantly dishonest, in my opinion.
So let's talk about your article, The Path to Full Stagflation. Talk about the problem first, and then how long do you think it lasts?
Sure. So stagflation is a phenomenon where you have three things generally materialize. The last time we saw it in the United States was really in the 70s. You have high and rising or persistently high inflation. You have slowing economic growth, and you have rising unemployment. And stagflation was, of all the bad things it did, it's the one blessing was it sort of like was the final nail in the coffin of Keynesian theory. But stagflation is a particularly nasty set of circumstances because, when you have a regular recession, usually you have slowing economic growth, but you also after a while get slowing or lowering inflation and falling prices, disinflation or deflation, because the drop off, the paucity in economic activity leads to falling prices. Currently, we have two of those criteria. We have persistently high inflation, sticky inflation, where now we're seeing certain goods prices are rising again. We've got some tightness in the market and credit markets because of the failure of a few banks. And now the Fed had originally said 2 months ago that it wasn't going to raise rates anymore. They were going to pause in this 5 to 5.25% Fed funds range. Now they're saying, after the CPI on last week, that they may have to raise some more. Lori Logan, one of the Fed officials, said they might need to raise rates more. So we've got the high and sticky inflation, and we've got the slowing growth. We had a fourth quarter 2022 GDP number of 2.5%. Now we have a first quarter GDP number of 1.1%, which may get revised lower. So the question is, where's unemployment? And in this article that's up at AIER, I noted that even though the federal numbers say 3.4, 3.5%, which is, it's true, it is a historical low, states and federal government draw from different sources. And if you look at the state numbers, I looked at first-time unemployment claims, and I looked at WARN numbers. WARN is the Workers' Adjustment and Retraining Act of 1988. Both of those indicate that the number of people filing for unemployment and the number of companies that are filing WARN statements or versions of them are rising very rapidly. So my view is that it may be that the federal numbers catch up, that they're lagging right now, but if we continue to have the kind of high unemployment numbers that the states show, we will have stagflationary dynamics. We will have sticky high inflation, slowing economic growth, and rising unemployment, which would be a really awful set of circumstances, worse than the run-of-the-mill recession.
I don't think, I want to comment on unemployment. I don't think it matters anymore. Meaning, people are having less and less kids. So I mean, people are having less children, except me, I have 7. But on the whole, if somebody has 2 kids, that's a lot today.
Yep.
And our worker pool is shrinking because the baby boom cohort is retiring or being pushed out of the labor, so that labor participation rate. And then you have 20-somethings still really living in their parents' basement till they're like 35 now. So, I mean, this is just like conjecture. It's not based on any real data. But I know there's the shadow stats guy who says we really have a high unemployment rate.
Right.
But could it just be that this 3 or 4% is just 3 or 4% of a smaller number? So it really doesn't even matter anymore as indicative of whether the economy is growing or the stock market's growing. And you know what I'm saying? Like, it's sort of 20 years ago.
I think you're right. We're using a lot of numbers that we've been using for a long time. But one of the things I've wondered, and it's directly related to your point, is, the Fed is using these tools. It's using interest rates, the Fed funds rate. It's using the balance sheet. The last time these tools were used a lot was in the 70s. And then we had a very goods-focused economy. We had a goods-centric economy. We now have a financialized service economy. Do those tools still work the same way? I'm not sure. The other thing is, as you pointed out, all of these numbers, unemployment numbers, numbers about GDP, they draw from data sources, which at times have to do with polling. The numbers are estimated. So, we like to think of economics and finance as sort of like exact sciences. A lot of people, unfortunately, think that, what I do is like being a physicist. It's not. It's a lot of reading tea leaves. It's a lot of discounting numbers and, thinking of reasons why the numbers don't work anymore. Economic measurement is actually one of the other areas I cover. But I think you're exactly right. And another thing to your point is that, the gig economy is huge now. I mean, I meet people who, they'll say to me, well, I don't really have a job. And I'll be like, well, how do you make ends meet? Well, I drive for Uber and I do this and I do, and I edit articles on Fiverr. And I was like, well, then you have like 6 or 7 jobs actually. And they say, yeah, but I mean, I wake up as late as I want and, I pay my rent. So yeah, I think the definition of work, what constitutes work, what constitutes full employment, all that sort of thing is very much in flux right now. So absolutely, we don't really know what we're looking at. The best we can do is look through these old metrics we've got, see how well they conform, and try to be ready for the next time this happens. I think that's the best it is. But my article was only saying, by conventional definitions, we may be facing a stagflation. And however you look at employment and those sorts of things, high inflation, slowing economic growth, and whatever people are caught within the filter of employment that are accurately described, it's still a lousy set of circumstances, and it's bad for your financial and probably financial and general economic health.
So in the final 3-4 minutes of the interview, what do people do with their money? What opportunities to seize right now in the economy for people's portfolios or certain risks to avoid?
Right. So I actually, in anticipation of this meeting, did a little research, and I looked at what things did well, what asset classes did well in the 1970s when we had a true stagflation, and a really nasty one. I remember, I'm born in the early 70s, so I remember being 8, 9, 10 when interest rates were really high and all that sort of thing. Not because I was taking loans, but because I heard my parents talking about them. There's really 4 areas that did well in the 1970s. And again, these are by no means recommendations. Talk to your financial advisor, make sure it's appropriate for you and all this stuff. But the 4 areas that did well in the previous stagflationary periods are gold, energy, agriculture, and real estate. Real hard assets, which, there's a market for. There's only so much they can depreciate in value because most of these actually generate some sort of earnings, not really gold, but all the others are things that are very difficult to replace. And they represent really, the hardest of hard assets: gold, energy, agriculture, and real estate.
Oh, that's great. Gold, energy, agriculture, and real estate. Although I would add,
yes, sir. Sure.
2 years ago, we had a guy, you ever hear of David Ranson?
Oh, yeah, sure.
And he was left. Yeah, I don't know how old he is, but he's an oldie but a goodie. And that was when everybody generally was saying inflation's transitory. And he said it isn't. And he kind of gave the same tips. But what I wonder is, did everybody follow those tips the last 2 years? So gold's up. That maybe over the next decade it'll do well. But we might have those things start to cool, like real estate, things like that. I'm just a thought, but
yeah, I mean, timing is a big part of it, as I'm sure you know.
And it was like nobody listened. It was funny. I remember we had him on 2 years ago. We got comments. Oh, the guy's a dinosaur, and the guy was a gem. Like he was the only one. Because I interviewed all these economists, from Lacey Hunt to Jeff Snyder to you. I mean, a lot of good people. And he was one of the only people really sounding the alarm on inflation. Larry Summers, I guess, was one, but it wasn't big up until January of 2022, people were thinking the new normal was lower rates forever, and only a handful of obscure, like our technical market analyst, Stan Harley, said we were going to have interest rate hikes due to the study of the cycles. Rancid had some interesting gold theory that he can do something by looking at the forward price of gold divided by treasury strips. I mean, it's kind of an interesting, but whatever whatever that indicator was, it was pretty accurate. But everybody else, I mean, me included, was thinking, hey, you know, we have this low interest rate environment. We probably will have it forever because the government has, I mean, I saw the inflation risk too, but part of me thought and still thinks that the government has a vested interest in keeping rates down in order to service this debt, that we can't have these rampant rates. What do you think about that? Do you think rates will have to come down?
So, you know, it's funny. One of the jobs that Powell has right now, that's Powell, of course, the chairman of the Fed. One of the jobs he has right now, even besides the idea that, you know, even besides his duties of trying to get inflation down, all that stuff, is he's trying to claw back some of the Fed's credibility. Because since I arrived on Wall Street in the mid-90s, there's been this Fed put. The idea was that if things get bad enough, the Fed will lower rates. And so there's been this idea more recently that with the failure of Silicon Valley Bank and Signature Bank of New York and the troubles at First Republic and some other banks looking shaky, that they would definitely lower rates. But he and other members of the FOMC have come back and said, no, we are making a stable price level and lower prices the number one priority. That's a very good thing for the Fed because they have any number of mandates, some of which conflict, right? Financial stability would require lower rates. Squashing inflation would require higher rates. So which one do they choose? They have made clear that they want to focus on inflation right now. But the market doesn't believe them. If you look at market implied policy rates, if you look at Fed swaps, all of them are projecting interest rates of 4.25%, even some 3.75% by the end of the year. So I think what really matters right now is if the Fed keeps rates where they are, how much more has to materialize? How many more, you know, how high does unemployment need to get? How high do treasury rates have to get for them to start to lower rates again? Or, as you know, one of the Fed officials said last week, she said they may need to raise more. But every time they raise rates at this point, they're putting another group of banks who have the same issues as Silicon Valley Bank at risk. So, I mean, I understand that the Fed wants to claw back credibility after 20 years of being sort of this fireman on Wall Street and lowering rates and flooding the economy with money when they need to. But, you know, it's hard to argue with the market, and the market thinks rates will be lower by the end of the year. There's a lot happening right now. It's hard to say. Debt ceiling, pending inflation, more inflation, possible recession, possible stagflation. I think the odds are tilted towards lower rates, but we'll see.
Fantastic. This is Josh Jelinski with Peter Earle. Thank you so much for joining us, Peter. And folks, get the book, The Gold Standard, Retrospect and Prospect. And you can see more of his work at the American Institute for Economic Research at AIER.org. The article is The Path to Full Stagflation. I want to thank you for joining us, all of our listeners. And call us, 888-988-JOSH, and we'll get you the book, The Gold Standard, free when you schedule and keep your no obligation review at 888-988-JOSH. Thank you so much, Peter.
It was great to be here. Thanks for having me.